Hello everybody. So it looks like we survived a mini crash. If the market is to be believed, the market seems to be up today. And so title of today's video is Mini Crash Aftermath. The aftermath, a shopping list. Yes, yet another shopping list because it dropped slightly more, at least for the stocks that I follow on the channel. Yesterday, I was very thankful to Robinhood. If you're on the Patreon, you got my alert. I was able to get sub 330 MSTR, and I allocated twice my daily DCA, which means I'm going to have to take a few days off next week, not buying, if the market goes back up. And I mean, right now, the market is very positive. It seems like we were saved by the core PCE. If you look at all of the stocks that I cover on the channel, you know this channel is only high growth stocks, only stocks of the 21st century, stocks of the future. This is a growth-oriented investing channel. So today we're rebounding on my stocks, right? Microstrategy is nicely rebounding. Bitcoin is rebounding. Bitcoin hit 78 last night. Bitcoin has been holding up really, really well compared to the rest of crypto. Look at something like Solana and how poorly it did compared to Bitcoin. Nvidia, totally cannot understand why Nvidia was down yesterday. It's entirely ridiculous. I still cannot fathom why Nvidia was down despite beating, triple beat on 2 days ago, right? It triple beat and yet it was way down. Like this market, this risk-off environment is crazy now. We've seen way worse, and this is obviously not the first crash, so that's why I call it a mini crash. But surely this mini crash, had a weird feeling because nobody expected that within the first 100 days of a new administration, especially in the crypto space, when we had a president who said things like, you don't sell your Bitcoin, and when we had so much buzz around Bitcoin, etc. So I was surprised. I was caught by surprise. I consider this, of course, a mini correction. It could have been worse. It could still be worse. You don't know. We're always one tweet away from the market crashing on a Friday afternoon, so it could still be worse. I hope not. It seems like today we were saved by the PCE, the core PCE. It seems to be as expected, meets expectations, and so the market's really happy about that. It was very fearful. Of course, the PCE impacts the rates. Had we had a hot PCE, we would have had lower odds of rates dropping. You know my stance on this. I think it's all a bluff. I think rates have to drop regardless of PCE, regardless of inflation. I think rates are going to have to drop. Another possible reason why the markets are up today is Ukraine peace. It seems like a lot of articles are trending about that Zelensky-Trump meeting and could be a peace announced. Again, this has been an overhang on the market for the past, 3 years almost? So if this overhang were removed from the markets, that would be really, really bullish for stocks, which is why, last time I understand people were emotional, but I think this is a very good setup for stocks. I didn't understand last time why the market was crashing. I don't understand this time why the market is crashing either. Anyways, some lessons, right, about these quote-unquote mini crashes. Mini crashes mean risk off. It means that the stocks that I invest in on this channel are really, really hurt by these risk off periods. If you owned GM, this week I couldn't believe GM, right? GM's up on the week. GM did really, really well. If you hold old world companies that are going to be in trouble in the next 10 years, if you own these companies with a bunch of debt, in a period of a mini crash, for some reason, they seem to be fine, and it's the innovative stocks that are not fine. So the main takeaway of a crash like this is be so careful with margin. Be ever so careful with margin. I just started using a little bit of margin yesterday night in after hours because Microstrategy was just too low to pass up. But be very careful with margin because you can get margin call and forced liquidated, and that's the last thing you want. Buy a little bit in every market. I buy a little bit every day. If you have fees, buy it a little bit every week or something like that. But buying a little bit, to me, no financial advice, but to me, it helps me with the itch. I don't feel bad because I bought the bottom, and I don't feel bad either because I guess I bought a little bit at the top. So I'm always buying. I'm a net buyer. I don't believe in lump sum investing. I know this is a big debate on YouTube, lump sum investing. I don't really believe in that. I think a little bit every day. If you love stocks, that shouldn't be a problem. The idea that someone is so busy working 80-hour weeks that they can't trade and need to invest lump sum, I think is a little silly, especially today with a phone and access on the market on your phone all the time. Again, sometimes I bend the rules a little bit, maybe buy a little more if it drops, but barely. I barely bend the rules. I'm mostly steady in my buys. And great companies, again, in this crash, they've suffered for no reason, in my view, except that they're associated as a risky stock, and they're in a basket of risky stock with some money manager, etc., etc., etc. Great companies suffer for no reason. Furthermore, because of tariff fears and the stocks that I cover in the channel, very few of them are directly impacted by tariffs. Very few of them. Some people say, oh, well, tariffs, they're going to have a very hard time on the economy. It's going to lead us into a recession. But then you're multiple degrees of freedom away from your explanation, because if you say tariffs come, then recession comes, then my stock is impacted by the recession. You have to be in a recession-sensitive stock, and you have to assume that tariffs lead to recessions, and then you have to assume that you own a stock that will be impacted by a recession. That's why you're 2 degrees of freedom away from that reasoning. I understand that a stock that directly deals in international trade could be directly impacted by tariffs, but to me, this is not true for the whole market. And my main stance on tariffs right now is that we're still going to end up, if we do, we're going to end up into something silly like we did in 2018, which is this US will put tariff on wine and on, handbags and leather, and the European Union will put tariffs on jeans and on Florida orange juice. This really happened back in 2018. You can see little things that really, in the grand scheme of things, didn't have a major impact. I think we either get no tariffs or even get something tiny like this. And if we get big tariffs, again, what does that have to do with MicroStrategy, for example? Like, what does that have to do with Bitcoin? What does that have to do with Bitcoin miners? Well, it has to do something with that from the risk-on, risk-off standpoint in trade, but not impacting directly these companies. So anyways, the shopping list. Let's get started with the shopping list. The first one is MicroStrategy, down nearly 50% at 349. Remember, overnight, last night, it was under 230, went as low as 220. That's how cheap this stock traded. The bull market, in my view, is still on for Bitcoin. And of course, MicroStrategy depends on Bitcoin, right? It's built on top of Bitcoin. It's a company built on top of Bitcoin. The drop to 78,000 was likely to, quote unquote, steal Bitcoin from people who were leveraged. And technical traders, technical charts flooded Twitter yesterday night. That's all you could see on X, those technical charts. And you could clearly see that there were a lot of people who had placed bullish leveraged trades on Bitcoin at 78K. They got liquidated, and then Bitcoin bounced right back up. As far as MicroStrategy is concerned, last week we were shown that the convertible bonds are still oversubscribed. There are still well over $10 billion of convertible bonds to go for MicroStrategy. I am looking forward to Monday. How many Bitcoins did he buy? Right? Some people in the comment section say, oh, he didn't buy anything. He's not going to buy anything. We'll see. My guess is he will buy something. The ATM is still on. He's still got billions of dollars on the ATM, although he should wait. I think he knows he should wait. He's going to wait until he does the ATM. The ATM is still on. The preferred are still on. He's going to ATM on the preferred. Issue stock on the preferred. Bonds, regular bonds, may be still on for MicroStrategy. You also have the issue of collateralizing Bitcoin. You could collateralize the Bitcoin to borrow fiat to buy more Bitcoin. There's many options that this stock has. I do not understand why it was down so much, and I have put my money where my mouth is, as evidenced by this portfolio move alert that I gave on Patreon. I'm putting my money where my mouth is. I think this is way too cheap for MicroStrategy, and while Twitter is celebrating, I think a lot of savvy investors are looking at the stock seriously right now, looking at these prices seriously. Let me look at Mara. Mara now As you know, I consider Mara to have a ridiculous valuation. Yes, there are better miners out there, but for a little bit of a short time, we were paying an 8 or 7% premium on Mara. Now that premium went back up because of their Q4, which was quite outstanding. I did a full review of the Q4 of Mara. I'm very, very pleased. I want to point out that Mara, since they now reported their earnings, you have TradFi, who is even showing that stock as cheap. And TradFi usually has a hard time analyzing Bitcoin miners. They don't understand the dilution. But even with all of that, if you go on Google and you type Mara, it's showing a PE ratio of 8, the same PE ratio as General Motors. Where do you think the future lies? Is it in dispatchable compute? Is it in Bitcoin? Is it in AI? Is it the infrastructure of tomorrow? Is it energy like Mara? Is this the future, or is it a network of outdated dealerships with a company that is upside down on the debt, right? And this is not to pick on GM. I could pick on CVS. I could pick on so many different old world companies. Give me the S&P 500. Give me 20% of the S&P 500, and I could pick on it. So even a stock like Mara now is showing cheap on traditional metric like PE, and PE obviously, in my view, makes no sense. I never use PE. PE, the earnings is used for figuring out how much taxes you pay, right? You want your companies to show profits via the adjusted EBITDA line, via the cash flow line, not via the profits line, because profits mean pay taxes, and it means you're not doing as well. But anyways, this is kind of how this goes here. So cheap MSTR, cheap Mara, cheap. I haven't talked about similar lately, but similar is also cheap. There's a lot of cheap Bitcoin proxies out there. So let me now move on to stock number 3 and stock number 4, which I find way too cheap. Unwarranted, this drop on this one, and it's HIMS and LifeMD. HIMS is down 36% from the peak. LifeMD is down 39% for the peak from the peak. Now for HIMS, I have a pretty big position. My cost basis is well under 10 on HIMS, so I have a big position. I am not adding to HIMS, but I am definitely adding to LifeMD. If I didn't have HIMS, of course, you should understand that if I didn't have either of them, or if I had an equal size position in both of them, I would be adding both of them. It's just risk management standpoint. Right now, I like LifeMD. Why do I like LifeMD? Well, it seems to be correlated to HIMS, but it has a business slightly different than HIMS. One of the main differences of LifeMD, of course, is how cheap that stock is. That stock is down 37% over the past 52 weeks, but you can see an enterprise value over gross profit over revenue growth is trading at 0.02. The rule of 40 is not that far off from HIMS at a 65. And why is it trading so cheap? Why is it trading at a 0.02? That's because in this second line here in my spreadsheet, I assume they sell work simply. Watch that interview, that 13-minute interview that has been trending on X recently about LifeMD. Can't remember the name of the channel. Please put it in the comment section if you can remember. But great interview. The CEO talks about how he thinks, he said no financial advice, and I say no financial advice, but he thinks they can 10x fairly easily. At least that's what I say. When I look at the valuation, I feel that way too about LifeMD. One of the main distinctions between HIMS and LifeMD, of course, is the GLP-1. They're both down because of GLP-1 fears, but HIMS sells compounded GLP-1s, and LifeMD has taken a different route. They sell branded GLP-1s. So in a world where compounding is heavily scrutinized by the FDA, or in a world where compounding is not allowed, then you have companies like LifeMD who, on that tiny portion of the business that GLP-1s represent, on that tiny portion of the business, may actually fare better. So, GLP-1s in general, I think these stocks moving on GLP-1s is complete nonsense, because even despite the outstanding quarter that HIMS reported, GLP-1s are still only 19% of HIMS sales, and that's despite that. And if you listen to the HIMS conference call, you know that traditional categories, other categories are growing very, very fast for HIMS. For example, HIMS dermatology category is growing at something like 100% year over year for women, I believe it was, and 59% year over year for men. That's dermatology, right? That's their skincare division. HIMS addresses all sorts of conditions, not just weight loss, and it's firing on all cylinders, and it's growing in all different segments. For some reason, the market has just been focusing on GLP-1 on these two stocks, and so of course they bid them down as soon as Ozempic got off the shortage list. But for LifeMD, the CEO has been telegraphing multiple times that actually it's a good thing for them if GLP-1s fall off the shortage list, because LifeMD works with your pharmacy benefit manager and your pharmacy benefits. LifeMD asks for your insurance and tries to qualify you for some reimbursement for a branded GLP-1 via your insurance. That's the key difference between LifeMD and HIMSS on this one. On the pharmacy side, LifeMD tries to get you qualified via your insurance, and they also now sell the latest price drop of Zepbound, which is very competitive. If you look at the latest price drop of the branded Zepbound, not the pen, not the easy injector pen that is very popular on advertising on billboards on the side of the highway, not that one, but simply the low-cost vial, similar to the vials that compounders sell. Those vials, a single dose is $3.49 and a 4-pack is $4.99. No, that's actually for a 4-pack, but it's 2.5 or 5. But if you look, it's less than $500 a month. So now you're getting to a delta that is A, competitive, and that is B, with some insurance, you can potentially get barely more expensive for a branded GLP-1 via LifeMD. Of course, you still need to pay for the doctor follow-up separately in LifeMD. That's why LifeMD has a slightly different positioning in the market than HIMSS. But make no mistakes, in my view, the healthcare of the future, the healthcare companies of the future are the LifeMDs and the HIMSS of the world. And you know, that's the way I view it. So I'm loading on LifeMD right now. I think $5 is way too cheap for this stock. And another stock that I think is great for a mini crash aftermath shopping list, that stock is Celsius. So Celsius, 7 days ago, they reported the earnings. If you haven't watched my video, I recommend you watch it, of course. The stock is only up 14% from that day. On that day, it was up like near 35% at some point on that day. The stock traded well into the $30, and now we are back in the mid-$20 range. This is nuts. The short-term memory of the market, I mean, it's an opportunity, but it's crazy how the market has a short-term memory. Now the stock is barely up on this news, except that we've had the two main fears have been entirely suppressed by the CEO, because the main fear, well, first of all, tariffs, right? Celsius should not be impacted by tariffs. International is still meaningless for Celsius. Even if international were to be a bigger business for Celsius, the beverages would most often be bottled locally, which means that you would pay a tariff just on the ingredients, just on the proverbial syrup, which for Celsius is a powder, but anyways, you would be just paying the tariffs on a small portion. So tariffs are not a story in my view in the case of Celsius. Now, what was a story for Celsius, of course, what led the stock to crash last year was the Pepsi overstocking issue. And a lot of people were saying, oh, the CEO is lying, there's a problem at sell-through, the store is not sell-through. Of course, the CEO said that's not true, we're still selling through. But the market was saying, you don't understand, this is impression management. They're just using Pepsi overstock as an excuse to, you know, kind of defer responsibility. And so they thought it was the CEO embellishing things. Well, turns out, no, the CEO was not embellishing things. It was really a Pepsi issue. The sell-through is happening at stores. Pepsi is working for an inventory issue. Pepsi will reorder. That's the one minor thing we found out on that conference call, on the last conference call. But the major thing we found out on the last conference calls is the fact that they're buying Alani. They're buying the main competitor. They're buying the top one energy drink among Gen Z in Alani. They're buying it. Alani is going faster than HIMSS even. So now you have a company who literally bought a competitor. This is a perfect match. And when I look at the valuation, I get a 0.2 on enterprise value over gross profit or revenue growth, and I get a rule of 40 of 57. So I love this stock. I think this stock is now very, very cheap, and this drop is entirely unwarranted. And let me conclude with TransMedics. I will conclude with TransMedics. TransMedics, the revenue guidance was good. Not great, good. It exceeded analysts' expectation. They had it at 521. They said it would be 552 on the high end. I still believe they're heavily sandbagging. It's significantly lower than what I had it as revenue growth for the next 12 months. But anyways, I took the 25%. I took it down to 25% on my spreadsheet. You will note that it still looks cheap in my spreadsheet at an EV over GP over RG at a 0.42 for a type of stock that is typically well understood by Wall Street and that typically benefits from a much higher valuation from Wall Street. They essentially have the rule of 40, not quite, but almost. As soon as they're going to be done investing in their airline, my guess is that EBITDA margin will go back up and they will get back to the rule of 40. But one of the main reasons why I've always owned TransMedics has always been the certainty, well, it's not certain, but the guided certainty, the outlook, the firm outlook of 10,000 transplants by 2028. And so that would mean that the business, the size of TransMedics, would nearly triple 3 years out, and the CEO has kept that outlook of 10,000 transplants by 2028. Right now, in 2024, according to Gemini, they did 3,600. I didn't have time to dig into the reports to find the exact number. But anyways, they're roughly predicting a 3x in the number of transplants. This is why I think this 25% here is heavily sandbagged, because they got to do more than that if they want to triple their size of their business by 2028 and even bigger beyond. And so what I've always loved about TransMedics was the long-term guidance, and the long-term guidance is a stark contrast to how cheap the stock is right now, and it's a stock that I'm happy to own and happy to own for the long run. So hopefully this was a helpful video, helpful shopping list, telling you kind of what I'm looking at right now. This was not financial advice, not investment advice. This is just entertainment. Hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful day.